And hello, I'm delighted to be joined by my very good friend Fiona, who was one of the gang of four who were giving our predictions this time last year for how it was going to be in 2020. Boy, didn't we get it wrong, Fiona.
Well, I don't know, because I don't normally like to make predictions. So I think I chatted a bit more just about what I was sort of thinking to do in 2020. So
Of those things you were planning to do in 2020, did it go reasonably okay, given a global pandemic that was crossing over?
yeah, we certainly didn't see that coming. Well, I bought houses for a reasonable yield, manage those assets well. That's just kind of what I do. Pretty boring like that. Stick to my bread and butter. So yeah, I bought over £2 million of assets in these last in the last 11 months of 2020. So I still my balance sheet grew and it all sort of went well. So I think I actually exceeded possibly what I was aiming to achieve in 2020.
So I think we'd say a few people have a sort of bulletproof property strategy that works on a 100-year pandemic cycle as well. And we've seen a lot of people running into sticky water. So that was terrific then.
Yeah, it was definitely unexpected. As part of my portfolio of investments, I own a nightclub, and that's not fared very well this year. We still have an outstanding business interruption case, as people may have followed that case. It's being heard in the High Court. The FCA took several insurers on behalf of the insured to court and won, and they've appealed that. So I may in fact be getting quite a decent business interruption settlement as well come through, because my nightclub is still closed. But that's why I'm a big fan of diversification. So we could weather that within the rest of the portfolio of investments.
So that's a little nod to the past, but what of the future? I mean, if you made it sort of pretty smoothly through 2020, I guess you're going to have a pretty smooth 21 as well.
I don't know about smooth. I mean, I did have to work. Certainly when we start, towards the end of March, when I had to close the nightclub, I'd also moved house on the 20th of March into a big project house that we purchased in January. And then, I didn't really know what was going to happen with the rent roll. I was facing imminent, massive non-payment of rent, the likes of which we hadn't seen before. Luckily, that didn't happen. But preparing the business for that, potentially happening, I had to furlough 16 staff for most of the year. They've been furloughed. Core property team still were operating, working. Had to make sure that the safety inspections were done. My husband had to help out going into properties, making sure that all of those were still being done despite the pandemic. And we didn't close. I didn't go away in the summer. Normally I take August off and I spend it in my house in Florida. Didn't manage to do that. These sound like first world problems for sure. And I took a week off, third week of August. Then I had a completion on one of the days, and something else happened on one of the other days. So I still had 3 days off. So I've said to my team, we've earned our Christmas break this year. I've still got an exchange I'm trying to get through for the 23rd. But I've said to my team, I've certainly earned a Christmas break. So looking forward to getting a bit of rest. Am I looking forward to sort of 2021? I think 2021 is going to be quite different to 2020.
So it was all hands on deck then to get everything across the line then, I guess. And do you think 21 will be a bit easier, perhaps?
I think so. I mean, just touching back on 2020, one of the things that I was quite impressed about, I often will black a box situations and look at what we could have done differently, how we might have improved things. And I felt that the business held strong because of policies and ways of working that I'd adapted and built up over my over 20 years in property. Things like a repair and maintenance reserve, never, always having a couple of months mortgage payments in reserve, things like that, strong accounting systems that could follow what was happening. We also report to Experian, credit agencies. So in March, I sent a letter to everybody saying, take care in the plans, look after your health. And just a reminder, you may be protected from eviction, non-payment of rent, but we do still report to credit agencies. And luckily, my typical tenants are largely, right from upper blue collar to sort of middle white collar. so professionals, and they do care about their credit. So they were, the little superstitious things, but we hardly had any arrears. Almost all of our rent was received throughout, including our commercial tenants.
Which
So,
a marvellous achievement. And
we did very well, but I do like to think it's over 22 and a half years in business. So some of the pain and experience of the past and that led to things like reserves being put in place, all of those things may have indirectly led to the situation, how we were when we were in the pandemic. And, Granny always told you, save money for a rainy day. And, hey, it rained. It didn't just rain, it typhooned. And Granny was right. So having money set aside for those days, which we did, finally came to fruition. Because when I was in my early stages of the property investor, it was like, have money, buy a house. I never wanted to sit on latent capital because I always thought that was a waste, that could be deployed into a property asset. So that mindset shift, perhaps getting older or more mature in my business, to actually set these reserves aside and questioning the return on that latent capital as well, it paid dividends this year. Also put us in a position where we could leverage and exercise that onto deals and opportunities that were there. And that it's also a twofold strategy for me. It's the reserves that I have that are easily accessible and liquid. And also, as I often say, I have a lot of unencumbered properties now, so I can quickly and easily raise capital on those properties in times like this when things get challenged. But make no mistake, it was somewhat of a challenging year. I hardly had any time off, as well as living in a project, which meant that, and obviously children distance learning. It certainly, there was a lot going on, but I'm not afraid of hard work and challenge, and just got on with it.
And that, in a sense, is what we do, isn't it? Because when other people are frightened and scared away from a market that we've been in for a long time, and we know that the fundamentals don't change fundamentally, then we can push on and maybe look for opportunities that might not be there in normal times.
Yeah, that's true. So, and as a property investor, with my property investor hat on, I want, low asset values for high yields, and we're seeing both of those directions moving in the right way, because I put a 2-bed up for rent, we did in July. We had 12 applications to rent that, so I'm seeing strong rental demand now. Shortage of stock leading to that, and improvement in rental price inflation, re-renting things for at least 5 to 10% above what they were being rented for. So, those are things that are all good. I think it's just access to capital and finance, and the ability to move on those deals is the next thing to be considering. So what does 2021 look like for money? I've got 2 purchases going through. One's using private finance and cash, the finance pie, deal pie, and the other one is using just regular high street lending. It's a lender that we've used before, and they wanted to know everything. I mean, everything, not just SA 302s. They wanted full tax returns. At one point, I was joking, I wanted my son's report card. I mean, they asked for so much information. Luckily, I think I had to do a business plan and so on and so forth. And all of this is kind of, I'm used to as a property investor, but it was just amusing that they asked for at least 20% more documentation than they did last year, and they dropped the loan to value by 5%. So my broker says, the lenders don't really want to lend. They're putting up barriers everywhere. And we're in December. So what's that going to look like coming into next year? Because the lenders want to protect their loan books and not have increased debt and things like that. So if you've got access to cash or cash equivalent, like an unencumbered property you can bridge up quickly or things like that, you'll be well placed to move on those deals that we might see starting to unfold more and more in the marketplace.
Yes, and in the residential sector, of course, we've got, assuming the government doesn't pull any more rabbits out of hats like they've been doing with furlough and such, we've got the end of this temporary stamp duty holiday. So do you think that will have a significant impact, maybe from the second week of March onwards?
Yeah, well, I don't know about second week. I think it'll be starting to happen now, because I think a lot of people believe that if you haven't already got the deal agreed and it's in progression stage, you may not even manage to get that through for the end of March. So I've got these 2 deals, one's commercial, one's residential. So it's not really factored into my buying. but it's saving me money, I guess is the better way to put it. And I might take a little bit of a break February, March, depending what comes across the desk, and then see. And then, there might be people that are in a position where it depends whether you have to sell or want to sell. There'll always be an element of people that have to sell, and they'll have to be very, very realistic on their pricing. You
mentioned earlier a strong rental demand at the moment. What do you think is driving that?
Shortage of property, shortage of stock. I think landlords are exiting when they can, because it's very difficult. We've got some golden handcuffs around us. I don't know if they're golden, actually. 6 months notice to get your property back, and whether that even would then happen in 6 months. But the tenancies that may be ending now, landlords could be looking at, do I still want to be a landlord? Do I want to take that capital out and put it somewhere else, especially if I can't see any capital gains in the next 10 years? And I can put it into ETFs or other financial instruments where I can get 4.5%, 4%, and I don't have 320 pieces of legislation to comply with. I always say that being a landlord, buy-to-let in the investment class, you can go to jail if the worst happens. Just even if you had an agent, that's just defence in court. They would still take you as the landlord to court. So maybe landlords reconsidering shortage of stock. And that would be the largest driver, really. Lack of options and competitive market.
Something that people sometimes ask me, and I'll ask you now, is it's just occurred to me. If you were starting again, given all these hardships and things that slow it up for people, do you think you would go into property, or would you look at some other areas to invest?
Oh, well, I'm always interested by that. If you're starting again. So if I was starting again, would I have my mindset and my knowledge base, or would I be starting again as a beginner without any of that?
Starting again
are we talking about?
Starting again, knowing what you know now, but starting again, but just having all the thoughts implanted in you that you have now.
I mean, I think I could confidently say it wouldn't take me as long to build the balance sheet that I've achieved.
But would you? The question is, would you do it?
I would probably avoid some of the more high hassle strategies. Well, I definitely would. I might have to do the high cash flow strategy. If I don't have a pot of money, I'd have to go immediately into those high cash flow strategies to get cost of living covered potentially. But I'd try and move out of those as quickly as I could. And I'm talking about HMO, serviced accommodation and things like that. Are just high hassle, lots of moving parts. And then I try and get across to commercial investing, not development. So I do commercial investment. And optimization much sooner. I think it took me, I got my first commercial in 2006, and I think I started in 2001, 5 years. So I might try and get across to that quicker. I probably maybe joint venture. I don't actually do that now because we're well capitalized and we've got funds to do our own deals. I might consider maybe finding the right joint venture partner that's obviously well funded and working with them as well. But I'm more and more looking at business investments and other investments outside of property that just return a solid net yield that when I compare to, say, a residential portfolio net yields, and that's with true numbers, sharp numbers, because I think a lot of investors in property don't really have access to the exact net profit that they're making. So they delude themselves into thinking they're doing a bit better than they do, or they're throwing a lot of their time or their family time at these things. And so I wouldn't be as keen, but I mean, I'm very clear on where I like to invest, and it's in my set area. I don't really go outside of that. I've got plenty of deals here to keep me busy, and I know I'm getting that capital growth. Well, we'll see what the next decade looks like, but I easily let my property, and I let them for yields that I'm happy with that work with my numbers. So, but we don't just have a new year next year; we've also got a new decade. To the 2020s. There's a lot of things going on. Really, I had a very, very interesting talk last weekend. In fact, by Daniel Priestley, whose work I've always admired. He does the key person of influence stuff. And he was talking about some things that were really interesting to take on board and think about, and sort of do trickle back to, I suppose, property investment, what I'm thinking of doing. But one of those was about the baby boomers. So you've got one of the biggest population sort of waves of this century, the last 100 years, all turning 70 in this next decade. So they'll go from paying into systems to drawing income out of their investments that have spent such a long time building up. So what's that going to do to the marketplaces, and what are they going to do with that money that they're taking out? They're going to have businesses to sell, and they're not particularly sexy businesses, like elevator shaft maintenance. And who's going to be there to buy those businesses? Because millennials don't want to buy them. Millennials are all about access versus investment. So they're not also even particularly looking to own homes. They're looking to rent. And millennials, another major influencing group, they're starting to have families and settle down. So they're looking for sort of family homes, 3-bed, 4-bed homes. I'm a Gen X, so I sort of sit in the middle. And I am about investment and ownership, as you know. So, the next 10 years we'll be seeing the effects of the baby boomers retiring. And we're also seeing globalization of the workforce, especially accelerated by the pandemic. So I think the statistic was over 60% of the world has now got internet access. So you've got people in sort of these third world countries that might have been on $20, $30 a day. Their day rates rising, $50 a day. They're earning more money. But unfortunately, in the first world countries, that some of that work that might have been done by the local workforce, the bottom of the sort of work pyramid, is now being moved offshore. So they're actually day rates shrinking, and there's a meeting in the middle going on. And there's going to be certainly some disenfranchisement going on, and the government's going to have to step in and help those people. And how's that going to work in terms of the property market? I see anytime we've got a property out, we get universal credit applicants and all that, people that need sort of support from the government. And the landlords are notoriously not very accepting of that kind of tenant. The lenders, in fact, have even banned them, but I think the government's talked them around now. So what's going to happen, for that sort of element of the workforce, and the automation of jobs is becoming increasingly obvious. And a lot of companies realise the workforce can work remotely. So we're going to have people, that moving out of city, decentralisation of cities, as people think, do you know what? I can work out in Norfolk, or work out in Ely or somewhere like that, and live in a much more spacious house. And people will be also looking for houses with gardens and Zoom rooms even, or spare rooms. So that sort of thing is really interesting that I think about. And I think about the wealth, what are the wealthy doing? This increased globalization of the people. They're no longer bound by geographic borders anymore. And, what's that going to mean? I mean, have you seen what's been going on in New York City? They tried to bring a wealth tax in, and a lot of the top ultra high net worths, the 1% in New York City, have just started leaving the city. You've got Elon Musk's moved to Texas because there's no state tax. So, people think, how are we going to pay for COVID? Well, let's get it off the wealthy. It's not going to work. They are more mobile than they've ever been. So where's that going to land then, the COVID bill?
Yes, I mean, there's that story, isn't there, about the 3 or 4 friends in the pub who have different wealth levels, and that each of them are buying a pint or something, and then there's a discount, and all the people at the bottom are quite grumpy, and the guy at the top, who was paying 4/5 of the bill, just doesn't come the next week, and I think that's a good illustration. If you discourage the wealthy from living in your country, they will leave. They are mobile. They are the section of that population that has more choice than anybody else, and I think you're shooting yourself in the foot.
Yeah, I think we'll see global enclaves of wealthy building more and more, and a disparity and inequality of income happening. And I think rather than focusing on the very top, we need to be trying to make that meet in the middle a little bit more. And and we need to be doing something about some of this global poverty that's going on, global hunger. I mean, I read something like the UN is actually now getting involved in feeding children in the UK. I mean, that's just shocking. That shouldn't be happening in a society like this that we live in. So, really, it's And then also we've got the impact of the virus to consider. My husband and I bought Pfizer shares years ago. I'd totally forgotten. He was showing me. I was like, oh, that was lucky. And we have Pfizer shares in our portfolio because obviously they're involved in rolling the vaccine out. And, is this the first virus that we're going to see, or are we going to have many viruses? What are these governments going to do about doing some kind of global response? Because we've seen very different responses. We've got someone like Taiwan that's virtually smashed it. New Zealand, Australia, from where I'm from, very few really deaths. And then you've got America, you've got England, these countries that just do not seem to be beating it or minimizing its effect economically and health on the population. Like some of these other countries, Japan has doubled our population and was it 1,000 deaths only, whereas we have 55, 60,000 tragic deaths.
Every death is, of course, a tragedy. And to be fair to government, in the middle of March, nobody really knew what was going on. I think now we should have more of a handle on it.
If we see another virus in this next decade, are they going to be ready? Are they going to have a method of communication to each other to alert? And are they going to lock down quicker? The UK locked down in June. Australia locked down their borders in March.
Yes.
It seems like a sort of response. I think hopefully the UK government at some point will make their response more formalised and structured and stuff like that. I mean, it was great they built those Nightingales quite quickly, so they can clearly move mountains when they need to.
I mean, interesting that you pick up on that, because as we cut down rainforests, as the permafrost starts to melt, and all this is a result of sort of human activity, viruses and things that we haven't come in contact with as a species are suddenly out there. Some of them will be pretty benign, some of them won't, and I do think that's a very important thing to move forward. I don't think it'll be another 100 years before the next pandemic as it was with the last one. I think the time frame will be shorter.
Yeah. And the other thing is, I was thinking about this last night, sort of just wayward thinking, but more and more people are moving to this work from home basis. The wear and tear on your property, and as a landlord, your rental property, is anybody actually taking that into consideration with their budget forecasting and planning for next year? Because I was looking through our repair logs a couple of weeks ago just for fun, because that's what you do for fun. And I noticed the oven element, and I asked my property manager, what's going on with these oven elements? I've never seen anything like it. And he had 4 in a row. Luckily we have a full-time staff handyman, so we just buy the elements cheaply at cost, and then he goes and fits them rather than calling an oven engineer out, because that can be quite costly. And we got it resolved, but it's just got me thinking, wear and tear on our houses. People will be spending 30 or 40% more time at home. It's like having a car and driving it for many more miles than you used to. So
well, here's one question that clearly 2020 has been very different from previous years, and some people such as yourself have had to work a lot harder, have had to sort of redefine a lot of stuff, but have stayed afloat. But is there anything, drawing on what's happened in the last 12 months or something, that you think you might do differently in 2021 to the way you did it in 2019?
I think we're looking to bring in more virtual global workforce to deal with just some of the low-level, non-high-value tasks. Everything we do is on the cloud, which was lucky. So I was quite impressed. We moved to the home working element quite quickly. What I get concerned about is trying to bring in new team members virtually. I think existing teams move to home working, virtual working very well and very quickly and elegantly, but actually kind of onboarding a new team member in maybe a serious salaried 40-hour-a-week role, I haven't done that yet. I wonder if that's going to cause some issues. And I think companies are becoming more and more aware of cost cutting. They've got the time to focus on stuff like that. And then maybe making some workforce changes and bringing in more of those global workers. So we could see unemployment rising even higher, and unemployment is something that will trickle back and affect us as landlords. So that's something certainly to be keeping an eye on. because the government, with furloughs and all the money drugs that they pumped into the market, once they sort of dial down the flow of those what I call money drugs, money and benefits and all the rest of it, when they try and get the economy off that, what's going to happen? So, that'll be something to certainly keep an eye on.
Fiona, thank you very much for sharing your insights into the year ahead. I hope you'll be in a position to join me at the same time next year to reflect on what is bound to be another kind of groundbreaking year, possibly unlike many of the others that we've seen before. But at this point in time, can I wish you all the best for Christmas and for the coming year? So, summing up, what's your takeaway or takeaways for 2021 then, Fiona?
Ooh, 2021, it's almost on us, isn't it? It's the start of the year and the start of the decade, the new decade. So, well, I don't do predictions. I just do Fiona's sort of feelings and thoughts. But I think we're going to see some sharp pricing. There'll definitely be deals out there, and it could be that nirvana for me as an investor of asset buying, prices falling and rental inflation rising, yields rising. And the key to that's going to be the ability to move on those deals, the ability to finance them. So having good working capital base you can use to deploy and take advantage of those sharp prices. So that'd be quite key to be able to do that. And as I said, I touched on, because of a shortage of stock, I think we'll see, especially every area is different, but in my area, definitely seeing rental inflation, where things that, I might have rented for $975, I'm repricing and putting back on when the tenant's left for sort of $1,050 or $1,100, which, is significant across a portfolio of double digits. And I'll see, this digital, more and more of the digital world. We are very much cloud-based, which was a benefit in March when we had to shift the team to home working. So our business was already cloud-based. Maybe there's some ones that aren't quite there yet, or may have moved across during 2020. We'll see more and more of that globalization of the workforce. Landlords using virtual VAs in other countries, using cloud-based software and things like that to manage their rentals and the tenants and advertise and stuff like that. So more of that globalization and digitization. Hopefully we're not going to see more of the government's influence meddling, I don't know if that's the word, in the property market as well. So they've certainly been getting stuck in this year. So we'll have to see what else happens. We as a residential landlord, we've got 320 pieces of compliance to adhere to, which is, I say property is the only investment class you can go to jail if the worst happens. If, your compliance isn't met and the worst and tragedy happens in your rental, as a landlord, even if you have an agent, if you're not managing that agent correctly, your agent's only your defence. And, the government really pushing many landlords to the brink. And we might even then see an increase in the exodus of landlords selling when their tenants, when they get their houses back. We're seeing many landlords facing significant arrears in 2020. And I would hope that didn't continue into 2021, but I'm dreading to say that I think that will be there. So unfortunately, there's that politics of envy where the tenants think that the landlords are big fat cats and got big deep pockets. And, if they feel the pinch on their side financially, maybe then not paying rent or things like that. I really like to see more help for landlords in that sense as well. So, yeah. And, we've got that increased culture of working from home, people spending more time in their home, increased wear and tear, and also the type of properties they might be buying now, where we see less flats, more family homes, more homes with larger gardens, less people wanting to live in the condensed settings like city centres and things like that. So that'll be an interesting thing to watch from a sales point of view.
So in terms of your own businesses, how are you going to respond in particular to what lies ahead in 2021?
That's an interesting question. So as someone running a PropCo, we'll do more of the same. We do have reserves for wear and tear, for insurance, accounting and all that sort of thing. So we'll be keeping a sharp eye on our reserve accounts. We need to add a little bit to the wear and tear now because of the fact people are spending more than 40% more in their houses, putting many more miles on their houses and their plumbing systems, their heating, electric systems and things like that. So we'll do more of the same in that sense. It's always prudent to keep a good financial house in business. Big believer in the basics of business, contracts, financials, HR and operations, all those sort of boring things. So we'll do that. I want to keep strong liquidity throughout the year. So we've been going through the portfolio and looking at different assets we might even sell. And I'm not a seller normally, but I did liquidate a little bit in 2020 to keep our cash reserves up. And we'll probably do a little bit more of that. I'm looking at getting a VA service in for some of the very low value tasks. And now where I might have got somebody into the office part-time to do that, I'm really seriously looking at that global workforce option and trialing that out as well. We'll do more, I said, more of the same. We'll be acquiring, no doubt. I'll probably look to buy between £1 and £2 million worth of assets in 2021. And we're also opening up to investing in non-property assets, like businesses or businesses that might have an property asset on the balance sheet as well. So we'll be widening our asset base and looking for investment outside of our property assets that will yield higher returns that can then possibly be brought back into the property balance sheet and buying more assets there. So I'm just finding those net yields on residential just diminishing, and with all of the different frictional costs that have built up over the years with government interference and various other things going on, I still like buying those assets, but I want to have another money spout source or alternative source that I can use because I'll get the capital gains on those residential even if the net yields are diminished. So, maybe taking part of the balance sheet, liquidating it, and put it into financial instruments, ETFs and things like that, index funds, bonds, preference shares, all that sort of stuff. And maybe the property business will actually have non-property investments linked to it as well, just to feed it a bit more money. But I certainly would be staying away from high hassle and aggravation strategies. There is, one of the things that concerns me when I look out into the activities of some of the early stage investors is exactly where they're putting their energies and efforts, because they need to be really making sure that the strategy they're following is serving them, that there's not a hidden better strategy for sort of twice the money and half the work that they're not overlooking because they're not even aware it exists. So be very, very, whatever you're doing, make sure that you're doing the thing that serves you the best, gives you the best return, is the safest for you and your family and your investment. So, keep ever mindful of those things and try and cast your mind and your planning and everything forward as far as you can, because being well planned is also obviously very important.
Fiona, thank you very much for that very succinct summary of events. It's been absolutely terrific. And hopefully you'll join us again at the same time next year, if not sooner, to give us your thoughts moving forward on that one. But all the very best to you for the coming year.
And have a good holiday. And I hope everybody has a successful and healthy 2021. And just remember, life's greatest wealth is happiness. So whatever it is you are doing, make sure that you're enjoying it and you're happy. If the pandemic in 2020 taught us anything about, the shortness of life and the importance of some of the most simplest of things. So I hope that your 2020 brings you everything that you want